Well, hello and welcome back to Principles of Accounting 2. I'm still your host, Dr. B. We're going to talk about relevant costing for decision makers. Let's jump into it. Throughout the past 7 weeks, 6 weeks, throughout the past 6 weeks, we've been talking about cost. We talked about variable cost, which are direct materials, direct labor, factory overhead. We talked about fixed cost, supervisor salary, rent, etc. We talked about direct costs, direct labor, direct materials, things that we directly trace to the process. We talked about indirect costs, costs that we cannot directly trace to the process, but we allocate using an allocation base. And since we've talked about all those costs, we want to apply what we've learned to make decisions as managers. And some of the decisions we're going to talk about are the make or buy decision, sell or process further, sales mix, segment decisions, keep or replace, determine sales price, and special offer decisions. But there's a lot of decisions we can make using cost information that we've talked about throughout the past few weeks. And what's the importance of making those decisions? What's the process of making those decisions? Well, you could use this to make any decision, really. First is, what's the goal? Why are you making a decision? What is the goal of making the decision? How do we identify? The second thing is to identify alternative courses of action. Well, I could go with option 1, or I could go with option 2, or option 3. Sometimes there's more than 3. I collect the important information in the decision-making process, like the cost. I select one of the alternative courses of action, and then I analyze that decision. I do what we call an after-the-fact analysis. What are the costs I look at when I make a decision? Cost of acquisition, sunk costs, out-of-pocket costs, opportunity costs. These are just some of the costs I look at. I look at the two alternatives, or two or more alternatives. I look at the costs associated with those alternatives. I look at costs that can be avoided, and I look at the costs that are different between the alternatives. One of the costs I look at is called a sunk cost. A sunk cost is a cost that cannot be recovered. It's called sunk for a reason, right? Cost that cannot be recovered. It's already spent. It's a sunk cost. It's gone. I already spent it. Gone. It's a sunk cost. An out-of-pocket cost, just as it sounds like, it's a cost associated with the decision. And then an opportunity cost is the cost that is foregone, meaning if you select one alternative, the alternative that you did not select is the opportunity cost. So sunk cost. This money I already spent. Okay, it's gone. It's sunk. Yeah. Sunk costs are costs related to past decisions that cannot be changed for the future. It's money I already spent. It's sunk. It's gone. Okay. It's also irrelevant to future decisions because I already spent it. I can't recover it. It's a sunk cost. Out-of-pocket costs. These are the costs associated with making a specific decision. They're very relevant to making the decision. And the opportunity costs are the costs foregone. for selecting one alternative over the other. The opportunity cost is the cost of the other decision that you did not make. Opportunity cost. We need to look at costs that are relevant to making a decision. One of those kinds of decisions is called the make or buy decision. Oh, this is a good one. Okay. Make or buy. In manufacturing, we know that there are variable costs associated with making a product. Direct materials, direct labor, and factory overhead. These are our variable costs with making a product. Those are also the costs of making a product. You know that. We've been talking about that for weeks now. Do I make the product with direct material, direct labor, and factory overhead, or do I purchase the already made product? That's a decision that we might be faced with. So we look at the costs. Let's take a look at an example here. This company makes auto parts. Okay? This part that we're looking at here is a starter. It's a very small component that goes into the ignition for starting a vehicle. It's called part 417. So this company makes part 417, which is a starter. There are direct materials, direct labor, and factory overhead to making this starter component. Direct materials are 45 cents. Direct labor is 50 cents. Factory overhead is overhead applied, predetermined rate, predetermined factory-wide overhead rate, 50 cents. It's 100% of direct labor. That's what the company selected, giving us a total cost to make the starter of $1.45. Okay, so now I know how much it costs us to make it, $1.45. Now I need to make a decision, should I buy it or should I make it? Well, here's a couple of things I want you to consider. If I buy it, I can buy it for $1.20. Now, if that was the only information you had, $1.45 versus $1.20, you would say, yeah, I'll buy it. That makes sense because it costs less to buy it than it would to make it. $1.45 to make it, $1.20 to buy it. Not so fast. It sounds like a logical choice, but it's not, and here's why. In the decision process of making or buying, if we buy the part, we would eliminate part of our overhead cost. Because as you know, some overhead cost gets applied to the manufacturing process. So in this case, instead of overhead costs being 50 cents, it would only be 20 cents. The reason for that is because that component costs 30 cents of overhead to be applied directly to the cost of manufacturing that product. So in the analysis, we look at taking out that part of overhead if we were to purchase it. That brings us the total cost of making the product down to $1.15. So that's why sometimes you see that a company might make a decision to make the product versus buy it, although technically, yeah, it costs more to make it, but it costs less to make it than it does to buy it because of the difference in overhead. That 20 cents in overhead, I can't get rid of that because that's like rent. I still got to pay rent even if I don't make it. I still got to pay salaries even though I don't make it. You see what I'm saying? Still got to pay the utilities even though I don't make it. So that 20% represents. So if I don't make it, I can take out part of overhead, but not all of it. So therefore, the cost of making it technically is less than the cost of buying. So how do we decide? If the incremental cost to making the product is less than the cost of buying it, we will continue to make the part. Sell or process further. This one's a good one. Think of oil, petroleum. Petroleum or oil is what we get out of the ground, right? Oil is used for various purposes. We use it to heat our houses. We use it for electricity. We use it for its byproducts. Oil can be sold as it is out of the ground, or it can be processed further. It can be processed further to make other products. Oil is the primary component in making gasoline for your car. It's used for making kerosene for heating. It's used for making other products, right? I can sell the oil as it is out of the ground, or I can process it further to create new products. You would only process the oil further if the additional revenue that we would get from selling those new products exceeds the incremental cost. So, for example, so let's say it's an oil company because the fast track one's good, but it's not great. Let's say the oil company pumps 40,000 gallons of oil out of the ground, and they partially process that oil further to become gasoline. Cube. Processing costs are $30,000. 40,000 gallons of oil unfinished can be sold as they are. 50,000, or it can be processed further to create kerosene and other byproducts. Processing cost to process it further will be an additional $80,000. So it will yield a total revenue of $150,000. The company has to decide whether to sell it as it is or process it further to create the new products. If we look at it from a graphical perspective, sell it as it is, we'll get 50,000. If we process it further, it'll cost me an additional 80,000 in cost. But it'll yield me an additional, what was it, 70,000 in revenue? Or I'm sorry, 20,000 in revenue? Yeah, 70,000 in revenue. Or 80, sorry. Total will be 150. So obviously, yeah, I would make more products. Now, the reason why you see 0 for the incremental cost, sell it as it is because if I already spent that money, it's a sunk cost. You don't use sunk costs in decision making. You've already spent it. It's irrelevant. Okay. So if I sell it as it is, revenue is 50,000. Sunk cost is, the incremental cost is 0 because it's a sunk cost. No additional cost, it's sunk. I've already spent it. So my income would be 50,000. If I process it further, I get an additional 100,000 in revenue. But I have to spend an additional 80,000 to process it further. Total incremental income would be 70,000. So the decision should be, yeah, I'll process it further because I'll yield an additional 20,000 of incremental income. Here's another good one. Decision to either scrap what you've done so far of defective products or rework them to make them functional again. Scrap or rework. So let's say you go through the manufacturing process, you made 100,000, you made 10,000 units. Then after you've made the 10,000 units, you got to the end of the process and you were like, well, I screwed up. There's a design flaw. These aren't going to work. So you go to your team and you go, okay, I made 10,000 units, they don't work, they're defective. You say, okay, how much did it cost? Well, it cost $1 each to make. So then your team comes back to you and says, you know what? We can scrap the 10,000 units and get 40 cents each. For the when you bring something to a scrapyard, you get the residual value, right? In this example, 40 cents each. Or you can rework these for an additional 80 cents per unit. So you'd spend 80 cents more in order to then sell the 10,000 units. If you rework, the units can be sold for $1.50 each. Now look at this data, okay? It originally cost you $1 to make the 10,000 units. If I scrap it, I get 40 cents a unit. So that's a loss, obviously, of 60 cents on each unit. If you rework it, it'll cost an additional 80 cents and you can sell for $1.50. Well, if you look at that part alone, you'd say, no, that doesn't make any sense because I would lose 30 cents on each unit. Which loss is worse? Okay. Now let's look at it from a graphical perspective. Scrap it, I get 40 cents. If I rework it, I sell for $1.50, it costs me an additional 80 cents. My incremental income would be 70 cents. Here's why. Remember the rule of sunk cost. Don't consider the dollar we already spent because it's a sunk cost. I can't recover it. I already spent it. So I don't use that dollar I already spent in my analysis. That's why we don't see that dollar expense here. Because it's not out of pocket, it's a sunk cost. The out of pocket would be if I spend an additional 80 cents to rework it. And based off of our decision rule, our incremental income to rework it is greater than the scrap incremental income. So we would rework. Sales mix is another decision we make as managers to understand the products that we should be selling. We look at a combination of different products that we sell. Most companies sell more than one type of product. The sales mix helps us to identify products that are most profitable. So management focuses on selling products that yield the greatest contribution margin. Here's a quick example of this. I have products A and product B. Sales price for product A is $5, variable cost is $3.50. For product B, it's $7.50 sales price, variable cost is 50 cents. Product B has a higher contribution margin. As you know, contribution margin is sales price minus variable cost. It takes me 2 hours to make 1 unit of product B. It only takes me 1 to make product A. I could get a contribution margin per machine hour by taking the contribution margin per unit divided by the hours per unit. In this example, product A would yield me a higher contribution margin per machine hour. In this example, I would produce more of product A than product B. While yes, the contribution margin is higher for product B, product A, the contribution margin per machine hour is higher. I'd make more of product A in this example. Sometimes in business, we have to make a decision to eliminate a segment. Segment being a product line. Sometimes you have to eliminate a whole product line. For example, Kellogg's. The Kellogg's cereal company had to make this decision relatively recently. Kellogg's, as you know, makes a wide range of cereals. And the decision came to eliminate one of their cereal lines. How do they arrive at this decision? They looked at their avoidable and unavoidable expenses. Avoidable expenses are expenses that you would not incur if you eliminate the product line. Unavoidable expenses are products you would still incur even if you eliminated the product line. So the decision came down to their expenses. Avoidable expenses would be things like direct labor, direct materials. Unavoidable expenses would be things like fixed factory overhead or fixed expenses. Our company also makes treadmills, and they're looking at removing the treadmill line because they had an operating loss of $500 for the recent year. Let's take a look at the company. Treadmill division, we have sales minus cost of goods sold equals gross profit minus direct expenses minus indirect expenses equals operating income, in this case an operating loss. If I remove the treadmill division, I would save $41,800 in total costs. However, I would still have $6,500 in unavoidable costs. These are costs that I cannot remove. So a way to figure out what the change in income would be, we take sales minus your avoidable expenses will give you a decrease in income of $6,000. So the decision here would be to keep the division because you would lose less by keeping the division rather than eliminating it. The keep or replace decision. Oh my, this one's exciting. I gave you an example a long time ago. I don't know if you remember it. For those of you who know me, you know that I spent a lot of time working in hospitality as a financial controller. I was a financial controller for one of the largest hotels in New York State for quite some time. In that property, we had what we call a chiller on the rooftop. A chiller controls the air conditioning unit for the entire building. That's what keeps the building cool during the summer. The chiller broke. It was about to break. We had to make a decision to keep or replace it. If we kept it, that means we had to repair it. If we replaced it, that means we had to buy a new one. So we had to go through the decision process, and it went something like this. The cost to buy a new machine, $100,000. In our case, it was over $1 million, but besides the point. If I sell the existing machine and buy a new one, I could sell the existing machine for $25,000 at salvage value. Buy a new one for $100,000. I would reduce my variable manufacturing cost by $72,000 if I buy the new machine. This would be a total decrease in net income by $3,000. In this example, I would not buy the new machine because of the severe discount in net income. In the long run, we did end up replacing the chiller, and we did what's called a spread of our fixed asset over time. So you know what happened to that. Using information such as cost is very critical, especially when it comes to pricing. How do you set your prices for the products that you sell? A couple of different ways we do this. One is through target profit. We talked about that a few weeks ago. Target profit is the owner's expectation of the return on their investment. They build the profit into the sales price. Look at things like customer demand. How much is the customer willing to pay for the price? How much is the customer willing to pay to purchase the product? We look at competition. Who else is selling similar products? Look at differentiation. What are substitutes for my product? Also look at product life cycle. How long will the product last before the new model is replacing it? I price my products. Look at a couple different methods. One of those is called the cost plus method. Take the cost of the product, which is direct labor, direct material, factory overhead, plus the desired profit, how much I want for each product. There's 3 steps to this method. First is the cost per unit. Direct materials plus direct labor plus factory overhead per unit to get the total cost per unit. Then I determine the markup per unit, markup percentage. That's the percentage of profit that I want for each product. Then once I've done step 2, that helps me to determine the sales price per unit. The method is called the total cost method. Cost method, we take the product cost plus the selling administrative expenses, get total cost. Take the total cost divided by the total number of units we expect to produce, and multiply that amount by the markup. And we take the total cost plus the markup to get the total sales price. Target cost is another method. Competition is high, we use what's called target cost. Look at the market price for the product, identify the desired profit, and we apply the percentage of market markup. Another method for pricing your product is called the variable cost method. where we take that's where we take the target profit plus the fixed overhead plus the fixed selling administrative expenses divided by your total variable cost to get the markup percentage. Take your markup percentage plus your sales price, get your total sales price. Other pricing methods include things like value-based pricing, auction-based pricing, and dynamic pricing. A lot of other methods, as you would expect. Those are just a few. And one of the other last decisions that we would make as a manager is called special offers. Special offer is where we have the opportunity to create a special batch of products for a customer. The way we determine whether we decide to do this for a customer or not is by looking at incremental costs and incremental revenue. Incremental, as you know, is additional. Yeah? First thing we do is we look at the per unit cost. Look at sales per unit minus variable cost per unit to get the contribution margin per unit minus our fixed costs per unit to get the operating income per unit. Normally, we receive a $1 operating income per unit with a sales price of $10. We have an opportunity here, special offer. The offer is that we have a customer that will buy 10,000 units from us at $8.50 sales price per unit, which is $1.50 less than our current price. While it's a very low price, should we accept or reject this offer? A lot of it has to do with our capacity. If we do this, we will obviously have lower variable costs. Sales price $8.50 minus our variable cost, giving us a $2.10 contribution margin. Our fixed costs remain fixed because the business has sunk costs associated with it. Minus an additional 10 cents administrative expense, giving us an operating income of $2 per unit. The answer is yes, we would accept the offer. And an additional sales method is called times and materials pricing. You've probably seen this at an auto repair shop, where we look at time and materials for repairing a vehicle. Compute the rate in dollars per hour for direct labor, plus overhead costs. In that hourly rate, we mark up the materials, usually about 1.5 for auto repair shops. It's the cost of the materials times 1.5, which is the markup for the materials. It's expressed as a percentage, 1.5%. We estimate the number of labor hours for the job times the hourly rate plus the part times 1.5% to get the total cost per job. This is what that example looks like. Labor per hour plus the markup for the hours, giving us total rate per hour, profit margin, percentage times the cost of the labor times the cost of the labor. Is the total rate per hour plus the markup, 5%. And then we can price out the job. And that's how it works for repair shops. Any comments, questions, concerns about pricing, decision making, cost? Oh, good. Still with me, right? Okay, cool. Thank you, Chris. Okay. Um, if you think of anything, you can always email me, call me, set up office hours, whatever you need. I'm here for you 100% of the time, as you know. For this Sunday night, you have two homework assignments. One of them is essay questions. Essay questions. They are very short questions, okay? So here's how it works. The essay questions, I'm asking you questions. There are 5 questions total. I am expecting a short 1 sentence or 2 sentence response for each question. How is a profit center? How is the performance evaluated? You know that. We talked about that. Look at your book, look at outside resources, write down 1 to 2 sentences responses for each question. That you'll now also note the point value, points per question. Okay, that's a lot. So a total of 10 points, right? So please, 1 to 2 sentences response for each question. That is for chapter 24. Chapter 25, mixed true false multiple choice homework assignment. You got 2 attempts on that. Both of those are due by Sunday night. Any questions?
Yeah, so what would happen if I just wrote down the essay for more than a paragraph? I thought it was an essay.
No, that's fine. Yeah, no, that's great. I would appreciate that actually, because that means you really thought about it.
I was just joking. I just
If you want to go that far, you're more than welcome to. I'll totally accept that.
all right.
Thank you. Charity, anything? Any question?
No, you answered it. I was actually just going to ask you originally how many sentences did you want, but you already said it.
Yeah, 1 to 2. It doesn't have to be anything crazy. Yeah, good question.
Okay.
Cool. Okay, if you think of anything, you can email me, call me, set up office hours, whatever you need. I'm here for you all the time. As always, well, actually, before that, next Tuesday, that's our last session. Yeah, we'll do chapter 26, and we'll also do a review for the final exam. I'll tell you what's on the exam. As always, please stay safe. Wash your hands, especially around Thanksgiving. Wash your hands. Stay safe, wash your hands, do the right things. I'll see you all again on Tuesday. A wonderful rest of your day. Thank you so much.
Yes, sir. Thank you so much.
Thank you. Enjoy your holiday. Thank you.
You as well. Happy Thanksgiving. Catch you later.